ECN listeners, this is your weekly FX update brought to you by ECN. Today's weekly update, we will explore and break down the euro-dollar market. The narrative for the euro-dollar market over last week's trading session has been trumped by news feed surrounding ECB unexpected interest rate cut, and as a result, the diversion between the ECB's and the Fed's monetary policy couldn't be greater. Despite a softer than expected US non-farm payroll print, the demand for the greenback due to lack of alternatives will keep the dollar supported in the medium term. This commentary will be broken down into two components. The first one is the technical comment part of the commentary we will first explore. The euro-dollar dramatic price volatility during the later part of last week's trading session have left the pair trading below the September 2013 low. Currently, the pair is trading between the 23.6% expansion marked by the 1.30196, which formed the intermediate resistance, and the 38.2% expansion, which formed the support tier at 1.29334. According to the SSI, which is commonly known as the Speculative Sentiment Index, last week's euro-dollar drop, induced by ECB interest rate cut, was no surprise, as retail traders flee into piling onto long euro-dollar positions. Current retail open long to short position is sitting at a ratio of 2-to-1. This extreme one-sided crowd sentiment leaves contrarian trading to expect further weakness in the pair to continue. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommend long position on the greenback. The euro-dollar cross opened today's Sydney trading session 3 pips above the established Fibonacci support at 1.2947, while the Fibonacci resistance is set at 1.2959. Since prior week's euro-dollar correction to the downside, the pair hasn't managed to retest the 200-day simple moving average. Therefore, the euro-dollar cross opened today's trading session below the 200 days, which is indicative of a long-term bearish outlook on the cross moving forward. This bearish standpoint is not validated on the short-term moving average front, as the pair opened today's Sydney trading session above the 5 and 10 but below the 20 and 30 day simple moving average, which is indicative of a hold recommendation on the moving average front. Moving along to the fundamental component of the euro-dollar commentary, an unexpected ECB easing policy resulted in a crash in the euro-dollar market during last Thursday trading session. The first leg of aggressive easing policy implemented by the ECB began with an interest rate cut from 0.15% by 10 basis points down to 0.05%. In addition to that, the bank also announced its plan to purchase additional asset-backed security, which forced the euro-dollar to break below the psychological 1.300 level. The implication of this aggressive easing policy is an increase in the pace of the divergence between the monetary policy of the Fed and the ECB. The component of the asset-backed securities is expected to roll out within the coming months, and the magnitude of the asset-backed security is not likely to disappoint. During the press conference, Draghi also signaled to the market that the Eurozone interest rate is at a record low, therefore additional cut is not likely to happen. On top of that, the bank has also downgraded its 2014 and 2015 Eurozone GDP and inflation outlook, as escalating geopolitical tension with Russia continue to pose risks to the growth of the Eurozone. The next plan of action is that the bank will most likely wait on the sideline and closely monitor how the market and the economy react to these aggressive easing policies before exploring further quantitative easing options down the line. Fundamentally, this has secured a bearish grip on the euro-dollar market for the remaining of the year. Nevertheless, the euro-dollar pair managed to rebound slightly over Friday trading session on the back of a softer than expected US non-farm payroll print. These rebounds appear to lack substantial follow-through momentum. Heading into this week trading session, there are very little risk opportunity after last week's ECB aggressive monetary policy change. However, it is still noteworthy to anticipate them. On Thursday, Euro investor can expect the release of German CPI number expected to stagnate at 0%, while the French CPI month-on-month is forecast to sluggishly grow by 0.4%. Wrapping up this week trading session is Friday Eurozone industrial production forecast to come in at 0.5%. Over in the United States, the ECB interest rate decision held precedent over all US Tier 1 leading economic indicators in terms of holding influence over the price action of the euro-dollar market. For instance, the US non-farm productivity quarter-on-quarter came in lower than expected at 2.3% when forecasts expect a 2.5% reading. On top of that, the ADP US non-farm employment component only added 204,000 jobs, below a forecast of 220,000 jobs. However, the ISM non-manufacturing PMI accelerated at its fastest pace yet by expanding at 59.6 when expectation was at 57.5. The highly anticipated piece of risk event came through during last Friday trading session with the US non-farm payroll print missing by a large margin. The US Labor Department reported that for the month of August, the economy also added 142,000 jobs, slightly over half of the expected job gain of 230,000 jobs. However, unemployment rate fell from 6.2% back down to 6.1%. This was enough to give the single currency a brief rebound to the upside. Market expectation continued to hold true on Friday's monetary policy, with its plan to end QE by October, and Yellen were most likely to remain muted on providing any hints with regard to the time frame by which the Fed can move away from its 0% interest rate policy. This recent disappointing job number can help the Fed secure its position in maintaining the status quo of its monetary policy. Nevertheless, moving forward, the demand for the greenback will continue to pick up on the back of a lack of alternative safe haven, especially during a time where the ECB has vocalized its aggressive easing stance. Heading into this week's trading session, the lack of risk event from the US will imply that volatility will likely remain muted. This coming Friday, the market can anticipate the release of US core retail sale month-on-month forecast to come in at 0.3%, while the US sale month-on-month component is expected to come in at 0.6%. In addition to that, the Michigan consumer sentiment is forecast to come in at 83.2. Thank you, everybody, for spending your time with us, and have a successful trading week.